Last time I was up, I guess it's been a few months, I talked about our stock funds and how they compare to the S&P 500 and how they compare to what typically you'll see out there with financial advising firms. And if you look back, you can pull up Google, Forbes articles, Money Magazine. Less than 70% of the time, the mutual funds, which is where most people are placed long term with their financial retirement and investments, most of the time they do not match the S&P 500. Most funds do. About 70% do not match the S&P 500. And those that do better, that's great. But the point is, the S&P is kind of the benchmark and standard. The top 500 companies in America are the benchmark and standard. And so we talked about a little bit our fees and how our funds have matched up against the S&P, most often beating the S&P. But I'm going to go the opposite route today. So I'm going to sell against all of that. And just so you can see, investments aren't as simple and easy as I put my money in and I buy and hold and I'm in it for the long haul. Kind of a typical thing you'll hear when you're invested with a large firm. Well, you're in it for the long haul and you can't outbeat the long-term returns of the market. So these are just common things said. But we really like to look at what's age appropriate. So if you're 35 and you're investing, should your goals be different than if you're 65? Would everybody agree with that? That if you're 35, your investing goal should be 65? Why is it that most people, when they're 65 and they come into my office, are still doing the exact same things they were doing when they were 35? And it just makes no sense to me whatsoever. Anyway, so what I'm going to do is I'm going to kill a couple sacred cows today. All right?
Kill the cow. Kill it.
So, not all stocks are great. Not all real estate investments are great. Not all annuities are great. You know, you have to understand what it is you're buying and for what reason. Okay? But I want to point out something about the S&P 500 over a long period of time up to December of 2015. Okay, so this is as current as I could have made this chart and had all the years. And I went back as far as I could and stayed on the board. So we went from 1998 to 2015. Okay, so it's, a couple years shy of 20-year cycle. So if in 1998 you were 30 years old, you're pushing, 50 here, and as long as you didn't sell in a down market, you were okay. For the most part, right? Everybody agree with that? But if in 1998 you retired, and these are your retirement years, then you might want to look at having your money in the market a little differently. Okay? So what this chart basically shows, these aren't maybe numbers, these are actual numbers. Okay, so there's nothing here that's like a hope and a promise, maybe, and this is what we can expect. This is what happened. All right? So in 1998, if you invested $100,000, okay, let's just say you had in your IRA, 401k rollover, something like that, and the red line is the S&P 500. Again, this is the 500 best companies, biggest, maybe not best, companies in America that creates the S&P. Okay? So in the first couple of years, you're doing really great. All right? The mid to late 90s were, a monkey could have thrown a dart on the board and everybody could have made money. It wouldn't have mattered what you bought for the most part. Market just was fantastic. Okay? So your $100,000 after 2 years would have been roughly $137,000 if you had S&P stocks. Okay? Now, again, that's a net. So if you're paying 1.5% in fees, let's say, which would be on the low end of a mutual fund's fees, these numbers would be less. But let's just skip any fees. Let's just talk the S&P 500. Then in 2000, does anybody know what happened?
.com bubble burst.
Yeah, exactly. And the government decided to take on Microsoft and, you know, all the other great things that happened. And we had a major, now I would call it crash. The market calls it a recorrection. So, semantics, okay? Now, then what happened in 2001? Anybody remember? Why did it drop again dramatically? 9/11. So what does that tell you? Because one had everything to do with world finance and our market, and the other one had initially nothing to do with that. That's how dangerous this world can be and how volatile it can be. So I'm not trying to scare you, I'm just pointing out the fact, the obvious. Okay, and then 2003, of course, as the market will do, it'll bounce back, and that's a good thing. And it should. Okay? And particularly because we're talking about not market issues here. These were, you know, terrorism and things that that were very different than businesses going out of business. Then it bounced. Then it took. So from 1998, it took 1, 2, 3, 4, 5, 6, almost 7 years, and with inflation, you're about square zero. Okay, so a little under 7 years, your 100,000's worth 100,000 and some change. Say 6.5 years. So, what's my point? My point is, again, if you're 35, that's not so bad, although nobody likes to throw away 6 or 7 years, do they, when it comes to growth and risk? But what if you were 75? You know, what if you were 55 and you're planning for retirement? And all of a sudden you go through a 6 or 7 year period where you've made nothing with your money. Okay, so that's an issue. All right, so, but it kept climbing, and then it got to a new all-time high in 2007. Your 100,000 was worth 145,000 and some change. Again, if you had the S&P 500. And then what happened? So then we went into a 2-year slide because of what?
Housing crash.
Yeah, I mean, loans we should have never given out, et cetera, et cetera, et cetera, right? So the financial world kind of cooked those books.
Who's we? I wasn't giving out any loans.
Yeah.
You pay for it, maybe. You pay for it, maybe.
Yeah. So from a real estate standpoint, this was really a tough time. And the money was tight. You couldn't get refinancing. I mean, these were really difficult times. And here we are in 2009, and your 100,000 from 1998 is worth how much? Anybody read that?
No.
100,000. So we've now just gone more than a decade, and we're back to square zero. Okay? Then it starts climbing again, a little bit of a malaise here, and then we've had some great years. Okay? 12, 13, 14, and up to the end of 15, and then we're starting to slide a little bit. We're starting to see a little bit of a slide. By the way,
That's a correction?
we're starting to, my bad. We're starting to see a little bit of a correction. Now, we were at an all-time high again. Okay? And interestingly enough, it took 1, 2, 3, 4, 5, between 5 and 6 years for you to get back to where you were at this point. Okay? So, it used to be, in the history of the market, the cycles are about 30 months. But in the last 3 major corrections, the cycles have been 5 to 7 years. Now, I don't know if that's going to continue, but that's something to concern yourself with. If you're pushing retirement or you're in retirement years, this is really, and this is the kind of things you have to really concern yourself with your retired dollar. Every dollar should have an objective, okay? So not every dollar would you do any one thing. You need to be diverse. But by the way, when the market crashed and your agent said, well, you're in a lot of diverse funds, are you really diverse? When the tide falls, don't all boats sink? That's not diverse, okay? Diverse is, I've got some of my money in the market, I've got some of my money in real estate, I've got some of my money in some safer instruments, I'm age appropriate. These are the kinds of things that you need to concern yourself with. Okay, so then you get over here, and by the way, apart from a black swan day, 9/11, do markets just crash all of a sudden? No. Historically, they tend to go down about 10 to 15%, and then they hover, and then they start slipping. And that goes over a little bit of time. It's not all at once. Now, there are black swan days in our history. 9/11 was a black swan day. No one could see it coming. It just happened, and in an instant, we had a real problem. Okay? Now, the green line is an indexed annuity. Okay? It takes advantage of the market without putting your money in the market. It's a very safe instrument. It doesn't give you the kind of returns that the market will give you in a good year. So if you see in the first 2 years, this is an actual 5-year annuity that just keeps getting repeated. So this is an actual product from an actual company with actual results, okay, based on that same $100,000. First 2 years, instead of your money being worth $137, it was worth $125. So I'd rather be in the market at that point, right? And I'm pretty happy, okay? But the next 2 years were pretty brutal. My $100,000 was worth $78. My $125,000 2 years later, if you can't read that, was worth $125,000. It's what they call zero is hero. Sometimes making nothing's the best thing you can do. Wouldn't everybody agree? Lose 48% or gain 0 and lose 0. That's how these work. So you went 2 years without making a penny. And by the way, there's no fees in these. So your money, thanks. So your money's still worth exactly the same. So that's proof there's no fees, like in the way the market works, where you typically pay 1 to 3%.
How do you realize a profit or take money out of the indexed annuity?
Okay, that's a good question. I'll hopefully get to it. I've got less than 2 minutes.
Okay.
Then we started bouncing back, and as you notice, the gains aren't quite as high. So you don't get all the gains, but you get none of the losses on these products. So that's why they're a significant product for a certain dollar. Okay? And then we get to the all-time high. I'm higher than the 2007 high. Okay? And then we have a couple of 0 years again. Isn't that better than the market crashing again? Okay? And then we start climbing again. And at the end of the day, having taken 0 risk, my $100,000 is worth $215. Okay, that's not sexy. That's a return of about a little under 5%. Okay, which is not it wouldn't get anybody overly excited, except for one major fact: the S&P 500 returned a lot less, and your money was always at risk. Now, taking money out of it, that's one of the best parts. That's a revolution to the annuities over the last 5 years. The old annuities, to take income, you had to generally trade your pile of money and annuitize the annuity, which I never liked. Because that just meant, I'm going to take this income, I need the income, but what if I die prematurely? That pile of money's gone. The insurance company just made out like a bandit. Not a big fan. So what they did was they realized, listen, the whole goal of this dollar right here was to take income. That's not the whole goal of all your dollars. Some of your money might be legacy. Some of your money might be liquidity. But this dollar, let's assume, was for income. Okay. So they have what they call an income rider, where they'll pay you income and you're still in control of the principal. And so if you die prematurely, that money goes to your beneficiaries. So that's a significant change. The reason why they can do that is someone realized once you start taking income, you're never going to give it up. They have your money to make money with either way. So anyways, I'm out of time. We got time for one question? Any other questions?
So I gave you one. Oh, no,
Right.
one more.
Anybody got any other questions? All right, Sally.
Not a question, but it's a testament to what you and Crystal both did for Tony and I, because we are in those annuities, and we are now getting money, and I don't have to worry, and I still have my principal, and it's so nice having a check from nobody except yourself to yourself, and it's great, and it's in there every month on the dime.
Yeah, was in a Forbes magazine article about 4 years ago. I'll end with this. They said the happiest people in retirement are the ones with the most guaranteed income. So, all right, thank you.